Silver just detonated through $91 in a single session, up more than 4% in one day, nearly $4 added in hours. And the chart candle isn't a cute rally, it's a statement. Here's what happened, clearly, in the first few breaths. The futures market is trying to keep silver contained, while the physical market is ripping the walls off the building. Registered inventory on the main U.S. delivery exchange just sank into the high 80s in millions of ounces. One major bank just pushed almost every delivery notice in a single day, and we are now 2 days from the next major delivery trigger. That is why silver moved. That is why the next level is about to break. And if you're wondering, so what? It's just a number on a screen. I'm going to show you the exact pressure points that make 92 look like a speed bump, not a ceiling. Quick intro, then we move fast. If you want straight market math, vault math, and the kind of data that actually moves price, subscribe now. One tap, no drama. Because this week is not a normal week, and you don't want to wake up after the move and pretend you saw it coming. Now let's talk about the lie that gets people crushed. They want you to believe the rally is done because it's already up. They want you to believe the move was too fast, so it must reverse. They want you staring at a resistance line like it's a brick wall. Meanwhile, the metal is leaving. The premium is widening. The biggest players are choosing bars over paper. And the system is trying to keep you calm while it runs out of oxygen. Look at the tape. Spot prints around $91, one day, plus 4.4%. That's not a casual drift, that's urgency. Zoom out just enough to see the pattern without falling asleep. This week alone, silver is up roughly 8%. Over the last 8 trading days, it's up around 20+%. Over a few months, it's up dramatically. The chart looks like a staircase that someone lit on fire. But charts are the shadow on the wall. The body is the physical market. Every one of those percentage jumps has a matching physical action behind it. Inventory getting pulled, delivery getting demanded, premiums staying stubborn, and the paper price getting forced upward to chase what real metal is already being paid for elsewhere. That's why 92 matters. Not because 92 is magic. Because 92 is the last place where the crowd still thinks the price can be talked down with technical jargon. Above 92, the story changes. Above 92, the headlines change. Above 92, you stop hearing pullback and start hearing short squeeze, shortage. Why is this happening, and is it too late? And that's when the second wave shows up. The level everybody is watching is $92. It's the final obvious resistance before triple digits on the international screen price. The number people see when they type silver price into a search bar. That's the psychological gate. Here's the uncomfortable part for the shorts. The path from 92 to 100 isn't crowded. It's open, it's air, it's momentum and panic and forced buying. And the market structure right now is screaming that it wants that air. You can see it in the rhythm. Break, pause, break, pause. 85 to 89, digest. 89 to 91, digest again. Every pause is higher, every dip is shallower. Every pullback gets purchased faster than the last one. That is not exhaustion. That is accumulation disguised as chop. Now I'm going to give you one trend signal that matters more than any influencer's opinion. The 50-day average has been climbing for months without a meaningful downshift. That means every dip for months has been a trap for sellers and a gift for buyers. It means the market has been training everyone to sell fear and then punishing them immediately. That's the setup for a level break. But the real reason I'm locked in on 92 is not the chart. It's the vault. Let's go to the number that makes my stomach tighten. Registered silver. Registered is the deliverable pool, the metal that is actually tagged and available to settle futures delivery obligations. People confuse this all the time, so let me make it painfully simple. Contracts are promises. Registered is the shelf. When the shelf is full, promises feel safe. When the shelf keeps emptying, promises become a confidence game. Registered inventory has dropped to roughly 87 million ounces. Read that again slowly. 87 million. Not total warehouse stock, not eligible, registered, the part that can be used to meet delivery without a fight. Now you might not feel how small that is, so let's ground it. Global mine supply is in the neighborhood of 800+ million ounces a year. The world uses more than it produces. That's the deficit story. But the deficit becomes real when you can watch a single exchange's deliverable pool drain. 2 weeks ago, registered was over 100 million ounces. Now it's in the high 80s. That's a double-digit million-ounce drop in about 14 days. That's not a normal fluctuation. That's extraction. And what makes it worse? The refill is missing. The inflows are not keeping up. New metal is not marching in to replace what is leaving. The door is swinging out far more than it swings in. In a paper market, that's survivable, until a delivery month arrives and too many people decide they want bars, not dollars. Which brings us to the signal that made me stop and stare. Delivery notices. On a recent day, 229 delivery notices were issued. One notice is one contract. One standard contract represents 5,000 ounces. Do the math. 229 contracts is roughly 1,145,000 ounces. Over 1 million ounces set to move. Now here's the part that changes the psychology of this whole market. One institution issued 228 of those 229 notices. 1, 2, 2, 8. That's not a normal distribution. That's not business as usual. That is dominance. That is urgency. That is someone moving size. And you don't move size like that for fun. You do it because you have to. Because your position demands it. Because your counterpart demands it. Because your internal risk desk is staring at a screen and saying, "We are not playing games this month." The market didn't move 4% in a day because of sentiment. The market moved because real metal is being allocated, and the biggest names are lining up on the receiving side. Look at who is stopping, taking, receiving those contracts. Major European and global banks. Major bullion institutions. Names that don't wake up and decide to stack because a trend went viral. They want the metal. They want it now. And when institutions choose metal, it tells you something. They see tightness ahead. They see a bottleneck. They see delivery risk. Or they see a premium opportunity that only exists when physical supply is constrained. And now, the timing. We are 2 days away from the next first notice day for a major delivery month. That's the moment the market forces decisions. If you are holding a contract into first notice, you either roll or you prepare to take delivery. Most traders roll. They cash settle. They play paper. But you don't need most. You only need enough to stand. And with registered sitting near 87 million, enough is a smaller number than people think. Here is what the bears will say, and I'll give it to them straight. A lot of open interest has been rolling. Big chunks have been pushed forward to later months. That reduces immediate delivery strain. Fine. But look at the paradox. Even with rolling, registered still dropped hard. That means the draining is happening anyway. That means the physical demand is not going away just because paper traders delay a fight. And here's the pressure cooker mechanic almost nobody respects until it burns them. When you roll a delivery decision forward, you don't delete demand. You stack it. You move it into the next month, on top of whatever demand already existed there, while the vault continues bleeding. So each cycle becomes heavier. Each cycle becomes more dangerous. Less metal on the shelf. More promises floating above it. This is why silver doesn't need a conspiracy to explode. It needs math. Now let's connect the exchange math to the global physical reality. Shanghai. The physical price in the Asian market has been printing well above the international spot price. Think triple digits. Think a premium that refuses to collapse. In a normal world, that premium would get arbitraged away. Buy cheap here, sell expensive there. Easy. But when the premium persists and widens, it's telling you something ugly. The metal is not freely available to move. There are friction points, logistics, rules, demand that eats supply before it can even travel. And that premium is the signal that the real price of silver in a market that wants delivery is already over $100. So when I tell you the screen price is headed to $100, I'm not guessing. I'm describing a catch-up. International spot is chasing a physical price that's already higher. Now here's a detail that should bother you if you're short. On a day when inventory in that market reportedly increased by several tons, the price still surged. Think about that. New supply shows up and the market says, "Thank you, now give me the rest." That's not a market satisfied. That's a market hungry. And hunger doesn't negotiate with your resistance line at 92. It runs through it. Now let me widen the lens for a second, because this is where the story gets more dangerous. It's not just silver moving. Platinum ripped, palladium ripped. Industrial metals led the day while the pure monetary metal gold was comparatively calm. That tells you the driver is not just fear. It's not just currency drama. It's not just a headline about rates. It's industry, it's supply chains, it's users who need metal for manufacturing and can't risk being short on the inputs. Industrial-led rallies are the ones that break shorts because industrial users don't trade metal the way speculators do. They consume it. They lock it. They pull it off the shelf and turn it into products that won't be melted back down next week. So the float shrinks. The tradable pool shrinks. And price moves higher because the market is being physically emptied. That's why the registered number matters. Because when industry and institutions start pulling at the same time, the system doesn't stretch. It snaps. Now, we also have geopolitics swirling in the background. Statements, tension, negotiations, risk premiums. That can add fuel, sure. But I want you to understand something so you don't get tricked by the wrong narrative. Geopolitics is not the engine of this move. It's lighter fluid on a fire that was already burning. The engine is physical tightness. The engine is delivery. The engine is a market realizing the metal is being spoken for. Now let's put it together and walk straight into the next question. What happens next? Here's my case, step by step, without hype, without romance. 1. The trend is strong and persistent. Months of higher moving averages, higher lows, and fast dip buying. 2. Registered inventory is shrinking quickly and not being replenished at the same speed. 3. Delivery behavior has turned abnormal. One major institution issuing almost every notice in a day is not random. It's a signal. 4. The biggest players are not exiting. They are requesting. They are receiving. They are choosing physical settlement. 5. The physical market premium overseas is already pricing silver over $100. 6. We are 2 days from a major delivery decision point. When you stack those facts, 92 looks less like resistance and more like the last place the market hesitates before it sprints. So yes, I think 92 breaks. Not because I want it to, because the metal is telling you it has to. But let's talk about the psychological warfare, because this is where most people lose even when they are right. When silver is moving like this, the exchange has a weapon: margin. They can raise requirements. They can force leveraged traders to liquidate. They can create a vicious intraday dump that feels like the world is ending. If you lived through the last violent smash, when silver spiked and then got hammered down, then you know exactly how this movie plays. People panic, they sell the low, and then the price recovers while the physical story never changed. So yes, a margin shock is a risk. A 10 to 15% pullback can happen even in a bull market. But here's the part nobody wants to admit. In a structural shortage, pullbacks are temporary and shortages are permanent. A price smash does not put silver back into vaults. A headline does not create new mine supply. A forced liquidation does not erase industrial demand. The physical reality is stubborn. Chemistry is stubborn. Manufacturing is stubborn. Delivery calendars are stubborn. That's why volatility is a tactic, not a thesis. Now, another risk is the peace headline, the sudden easing of geopolitical tension that removes a risk premium. Fine. But again, that does not refill registered. That does not close the premium. That does not reverse the delivery behavior. So even if the bonus fuel disappears, the engine keeps running. And the final risk is the simplest. Maybe 92 holds for a moment. Maybe the market tags it, rejects, and makes one more shakeout down toward the mid-80s. It can happen. Markets don't move in straight lines, they zigzag to break you. But if you're watching the right data, you'll know whether a pullback is weakness or just the system trying to buy time. Here is the only question that matters during a pullback. Did registered refill? Did the premium collapse? Did deliveries stop? If the answer is no, then the pullback is noise. Now let's talk about what $100 actually does to this story, because people underestimate the second-order effect. At $100, silver stops being a niche conversation. It becomes a mainstream headline. That's when non-participants become participants. That's when your friend who never buys metals suddenly asks, "Is this real?" That's when your coworker says, "I saw silver on the news." That's when the late money arrives. And late money in a tight physical market is not gentle. Late money is a stampede into a room with limited chairs, and the chair count is being reduced every week. So the danger is not silver hits $100. The danger is what happens after the world notices. Now, let me give you a cliffhanger you should sit with going into the next delivery window. If registered keeps sliding, And if a single major delivery month prints even a fraction of the kind of physical demand we've seen during recent stress periods, we could be staring at register dipping toward levels that make the entire paper structure look fragile. And I'm not saying that to scare you. I'm saying it because the math is visible. Promises don't scare the system. Delivery does. So here's what I want you to watch over the next 48 hours. Watch the delivery notices. Watch who issues them. Watch who stops them. Watch registered, not the chart. Watch the shelf, because the shelf tells the truth even when the screen lies. Now I'm going to ask you 2 questions, and I want you to answer them in the comments because it forces you to commit to a thesis instead of floating. First question, do you think 92 breaks on the first attempt, or do we get one last brutal shakeout before it goes? Second question, if spot prints $100, what do you think happens next? Slow grind or panic sprint? Drop your answer. I read them. And I pin the best ones, because the best call is usually not the loudest. It's the one that understands the mechanics. Now, quick and simple CTA before we close this out. Subscribe. If you want the vault updates, the delivery data, and the next trigger points without fluff, subscribe now. And hit like if you want this topic pushed to more people who still think silver is just a chart. Let me end with the cleanest summary you can hold in your head. Silver didn't rise because the crowd got excited. Silver rose because physical pressure is surfacing through the paper. Registered is shrinking. Deliveries are concentrated and aggressive. Premiums overseas are shouting real price above spot. And the calendar is about to force decisions. 92 is not a ceiling, it's a door. And when that door opens, you're going to hear the market change tone in real time. The only question is whether you're watching the screen or the shelf. Stay sharp, stay patient, and don't let a paper smash convince you the metal came back. Because it didn't.